Hi, this is Randy Finney with the right side of the chart, and today is Tuesday, January 26, 2016. And in this video, I wanted to do a quick overview of the U.S. markets, gold, oil, and a couple other things that I'm watching. I'll try to keep this one relatively brief. This is a chart of the SPY, the S&P 500 tracking ETF, a 60-minute chart. I'm doing this video shortly before the market opens. It's 9:24 Eastern Time, so by the time I'm done, the markets will be trading. But we're looking at yesterday's close here. And this is the SPY 60-minute chart. A few days ago, I think it was about 5 days ago, last week, I posted these targets that I was looking at for both the SPY and the QQQ, especially if these downtrend lines were taken out, which they were. If we zoom in here, we can see beautiful price action, breakout, little attempt to break out, back test, we closed pretty much on there and then gapped up. So, those targets have been hit, and as posted, that's where that's where I took out, closed my longs on, what was it, Friday, and actually took a little bit of short exposure. Didn't want to do too much going into the weekend. And then in the update on Sunday night, I posted that if I had a chance, if the markets opened up around where they closed, then I would add to that short exposure. And I talk often about managing overnight risk, especially when the markets are choppy. Volatility has spiked up, so you can expect gaps more so than when when volatility is relatively muted and we're in a trading range. So, that's key in this type of market if you are going to trade it. There's nothing wrong with hitting it hard intraday, and I'll talk about that in a minute. Posted a day trading opportunity in the trading room yesterday, and so I'll sort of share my style and how I trade this market. So that was in a nutshell. Posted on Wednesday of last week when we hit the lows going long there. That first target was hit, so booked profits, Apple, some of the index ETFs, and some other things, and then was able to short yesterday. And then I posted in the trading room as well that I decided, even though I had an additional downside pullback target, which I'll get to in a minute, I decided to cover all my shorts, and I went flat. I'm flat right now for the most part. I have different positions, but I'm referring to the equity ETFs. Right now, I don't have any positions there. So that is the SPY. That's where we're at now. And again, I'll talk on the shorter term charts in a second. I was looking for a pullback off the initial tag of this level, which we had. And I still think the odds favor continued move up to these second target levels. But personally, my confidence isn't high enough right now to put any money into it. In other words, I trade risk reward, and right now, if I can't make a strong case to be long or short, better to step aside and not get grinded out with the markets trading sideways or going against you. So that's the SPY. QQQ, similar story here. This is the target. You can see, we made just about a perfect tag of that target level. Look at the resistance line. And again, these were put up here. Let's see if I can pull these up. This goes back to, the 21st is when I posted these price targets on the QQQ, as well as, I think just below there, here we go, the SPY. So you can see, in the way these arrows are drawn, I don't always include all the squiggles, but that would mean a move up to that level, reaction, and then if and when that prices break above the top of the trading zone, T1 zone, then we'll likely move up to 193.20, which, like I said, I still favor that. So if you are a swing trader, not a very active trader like myself, there's nothing wrong with just keeping stops in place and trying to trail things up. And as I said before, this could turn into a multi-week, even a multi-month rally from here. But right now, I'm not looking for that. As I said, my confidence isn't high enough to engage the market. So far, again, this is back on the 21st, 5 days ago, last week. Those targets have been hit. And we'll take a look at the yesterday's pullback trade. Okay, this was the follow-up post. As I mentioned, and for those of you that have registered on the site and have used the trading room, you'll see a lot more trade ideas posted from me in the trading room than on the front page. The front page is typically reserved for market analysis, broad market analysis, the big things, and then little things that I see here and there, as well as the active trades that I do, that's the trading room is now a vehicle for me to post, a lot more of my thoughts that I'm seeing, little things here and there, little notes that might not warrant writing a full post and making an update on the front page. And as I said, I wear many hats. I consider myself, my primary trading style is swing trading, and as are most of the trade ideas on right side of the chart. Swing trades, some longer term trend and investment trades, growth and income trade ideas, all of which I do. I have an active trading account. I have long-term accounts. And as far as the day trades go, this is the first of the charts I put up yesterday. This is a 5-minute chart. It was posted, around 2:30 yesterday. If you look at the hash lines here, this is yesterday's open on the 25th, Monday's open. So you can see the S&P opened up just about where it closed. Now, this is a chart of the SPXS. This is what I used as my preferred trading proxy for one of the trades. I also traded the Qs yesterday, but to keep things simple, I use this chart in the trading room. So you can see that we opened up, and as I stated in my comments on Sunday night, if the markets were able to open up around that level, I would add some short exposure, which I did. So I was able to add some more short exposure there. You can see we came back to test the mornings. Well, everything's in reverse, so we're looking at an inverse ETF here. So I will say the morning's highs, if you will, because the S&P came back up. So again, this chart is in the inverse. And then I mentioned this is a key resistance level here, 2094. You can see it was defined by this reaction high, this reaction high, this reaction low. You go back and at least in the last few days. So that was a key level. And then the next chart here, I posted just a couple hours later that target was hit. I had suggested I gave these price targets. When you see the horizontal lines like this and you see the numbers, it's hard to distinguish. Sometimes I'll put T2 equals and give you a price target, which I've already adjusted. In this case, I just click on TC2000. I click to show the line. So these are the actual resistance levels or / targets. But I always suggest that when trading, take your profits a little bit early, because if a lot of eyes are watching that level, it's not uncommon to see the stock or ETF reverse just shy. So that's what happened there. I made a suggestion on that first chart. Actually, it was in the notes there to take profits 5 to 8 cents below those levels, and we just perfectly came up. I think that was the high of the day yesterday. I don't think it ever topped out 21.37. Versus that target, so exactly 5 cents below. So a perfect tag of the target, then we pulled back. And again, my thoughts are, I posted just closing everything out. I decided I'm not going to hold out for any additional gains, especially with overnight risk. Maybe I'll re-engage the markets again today, but it feels good, especially in this kind of choppy market, when you see these pretty favorable opportunities like this one yesterday and going long on the lows last Wednesday. Go in, hit it hard during the day, but then get out at night, or at the very least reduce your exposure. And that's what day trading is all about. My day trading style is identical to the swing trading style, meaning I'm looking at support resistance levels, divergences, things like that. And it's no different trading these intraday charts like this 5-minute time period as it would be the 1-minute chart or the 60-minute or even a daily or weekly chart for that fact. So that's the SPSX. And okay, now I flipped over to a live version of the SPXX. The market just opened, so you can see that after hitting that price target, and again, these were the actual levels, so we hit the target by coming within 5 cents of that level and had a reaction. So that's very common. The initial tag of resistance from below produces a reaction. We've come back to that, what was the key resistance yesterday, and my guess from here, this chart's live. If I draw it out, let's grab a screen draw tool here. We could see a bounce. We're overshooting it a little bit right now. And as I said, I have no desire right now. Think things might get a little choppy here. Trading may be a little difficult, but if we can hold this level, the market just opened, then we'll probably bounce back up here. And my guess is we may have one more reaction around that 21.43 level, again on SPSX. Maybe a little pullback, maybe not. And if we are able to power up through it, then we're likely headed up to that 2205-ish level. Okay, so back to the 60-minute charts. Here's the SPY. That's where we're at. So we've had that initial reaction off the first target zone, pulled back to that support level there, that 187.70 level, which coincided really, flipped the charts upside down, and that's where that SPSX target was yesterday for the day trade. And so if that level holds, then we'll likely power up. And my guess is the next time we visit this T1 zone, there might be a little hesitation there, but we'll probably punch up through. And if not, these are support levels, these horizontal lines, 187.70, then 185.90. So one by one, if they go, that starts to strengthen, take away from the bullish case. And I'd be really concerned if we got below that 185.90 by a fair margin, let's say a 60-minute close there. QQQ, oops. Looking at the 60-minute Q chart, same thing, went up, hit the first price target, pulled back. That was a horizontal support level that I had right here as S1. And so far, we overshot it by a hair, but if you noted, that's why I was focusing on that SPY or SPSX chart yesterday. Sometimes, when you're trading the broad markets, I always keep an eye on multiple indices at any one time. So in this case, the Q slightly overshot that support level. However, the SPY was at resistance and found perfect support on that resistance level. Again, we'll look at that here. So you can see that. So SPY grabbed resistance. So that's why that breakdown in the Q didn't go much farther. That was just a slight overshoot. And again, so we're likely to push back up here and just watch that 103.90 level. You have that 38.2 fib just above that. Let's see, that comes in around 104.27, 104.30ish. So that, to be safe, we'd have to take out that level, and that would likely open the door up, for move up to the 106.25 area. Okay, GDX, this is one I've been talking about recently quite a bit. So far, very bullish price action. I talked before this even happened, the possibility of this flush out move. We had a key support level here around $13, 13-ish level. That was taken out very impulsively. Again, talked quite a bit about that recently. And so far, that bear trap whipsaw scenario is in play. We had that a breakdown move. It proved to be a false breakdown so far because prices have impulsively snapped back up within there. Struggled at this resistance level here, these two lines, that's a resistance zone, and now gapped above that. So this is looking very good. Miners, the next big resistance level will be this reaction high up here. We actually have two. We have this reaction high from back in December of early December, and then again here in January, if I can get the crosshairs on it, January 7th reaction high. So that would be a big technical event to take that out in GDX. But between here and there is a lot of supply, we'll call it. This is a trading range that we were in from really early November throughout pretty much all of this year until that recent breakdown. So there's still some work to be done here, and until we really take out those levels and get up here, that was the target I had on the last GDX trade, which is still in play, that 1510 level. That goes back to the longer term charts. But either way, near term, it looks pretty good for GDX. So if you went long on a washout move or on a recovery back above this $13 level, that level should now hold. I could see maybe a brief intraday break, but we shouldn't revisit those lows. If we get anywhere close to those recent lows, that's not going to look good for GDX. And of course, the miners are going to go where gold goes. And as I mentioned all along, and one reason I was looking for that possible flush out move is the miners had sold off sharply, made a new low while gold was holding up very well and hadn't experienced the same low. And again, ultimately the miners will always follow the metal. So there's gold looking good. Gold just took out this previous reaction high here. So if it can build on these gains, this is the next target zone up here. There's a Fibonacci retracement level there, but that target zone starts to come in around 107.80ish, and so if gold continues to power higher, the miners will likely follow. And there's silver. I mentioned recently that a break above this downtrend line here would be a bullish event, and so far, as you can see this morning, we have a nice gap above. We tried to break that trend line intraday there. You can see the candlestick wick, but that breakout failed. We failed to close above there. And as of now, we have a nice gap up. So all in all, silver, gold, and especially the miners, as I always say, the miners are essentially a leveraged play on gold and silver. If you can get the call on gold and silver right, you're going to make 2 to 3 times that, especially when the miners have been really oversold as they are, because they have, there's most likely a reversion to the mean that's going to go on here. In other words, they have a lot of catching up to do from that temporary disconnect they just had. So the miners could actually go up 2-3 times what gold does in percentage terms over the next couple weeks here. If this scenario continues to play out, especially if silver and gold can get up to these next target zones. USO, this is crude oil ETF. We had that wedge overthrow, potential selling climax here, and then prices really whipped up sharply at the end of last week on Thursday and Friday, rallied hard. Yesterday they pulled back. There were a couple support levels here. I had mentioned this gap support. We had, this is the bottom of that gap. The gap that I'm referring to was from Thursday the 21st till Friday. That's the big gap. So yesterday we just slightly overshot on that sell-off and really made a backfill. And as I often talk about, on very powerful down days and up days, you tend to get these momentum overshoots where if you have a key support or resistance level, prices will slice through due to the momentum. And that's what's happened so far. So if bottom line, if USO can hold that level, yesterday's lows, let's just say to be safe, that's 854. It looks good near term. And the next, it still has some work to do, obviously, especially on the longer term charts to firm up the bullish case. But if we can take out those highs from Friday around 9:30, there's also some resistance to the left there. These are the next upside targets on the chart, 975, 1040. So for now it looks good. Let's just say I'm cautiously bullish on crude oil at this point in time. Okay, to wrap it up, let's just look at the agricultural commodities. I mentioned some of the grains and beans look pretty good right now. They still have work to do. This is soybean, SOYB, the soybean ETF. I'm watching this white downtrend line, what I call a minor downtrend line. The yellow downtrend line up here would be your primary downtrend line that comes off the 2014 highs. And this is a minor downtrend line which makes up this bullish falling wedge pattern. So prices have been tapping along that, really pushing up against it in the last few days, but we need to see a solid breakout, preferably a daily close above that trend line. And like I said, positive divergences in place. These charts have been posted lately in static form, so I won't go into too much detail now. Let's just take a look at corn. Corn has started to break out. It broke out above the downtrend line that I have. However, I have this horizontal resistance level here around 21, call it 2165-ish. We're at 2168 right now. So I'd like to see a little more upside. As well, I'd like to see the majority of these other grains and beans that I'm watching right now break out as well. So if that does happen, then corn, these are some levels. I don't have it as an official trade idea yet. I haven't added any targets, but that is one I'm watching. There's cocoa. I'm not so crazy about that chart, although it looks okay. Sugar, the ETF is SGG. And as I mentioned, sugar had a nice, very well-defined downtrend line, and a breakout back in, late September. Moved up very sharply and has been in a trading range since really the beginning of October. So we need to see a break of this trading range, an upside breakout of that range right here around the 36.12 level. That would take us at least to that $40 level, if not higher. And, so longer term, that chart looks good. However, you just don't want to go long within a trading range because these things can grind around for a while. And we're also not too far from the bottom of that trading range. Now, with that being said, one other strategy, a little more aggressive, you can position long here at the bottom of that trading range, which is the bottom's 31.28 with a stop not too far below. So let's say along here, it's currently trading at 32.15. So along here with a stop below 31 gives you minimal downside with a lot of upside potential. So you're buying at the bottom of a trading range. If that support holds, great, because you're looking at an upside target of at least $40. And you're only risking $2 on the downside to do that if you have a stop below 31. So there's one alternative way. Although again, I wouldn't engage the ags aggressively yet because a lot of those have not broken out. Once you see wheat, soybean, everything else popping, then you have a little more confidence that some of the others will follow. And of course, with the agricultural commodities, they each have their own unique fundamental variables, so they don't necessarily move together like the gold stocks. If GDX is rallying and GDX moves up 20-30%, you can bet your bottom dollar that 95% of the mining stocks are going to go up along with it. So I just wanted to make that clear that not all agricultural commodities are really birds of a feather, if you will. Let's see which other ones I have on here. Okay, and the last of those I'm watching is coffee. Coffee, the ETF is JO, and there's a downtrend line off the 2014 highs, and there's still, like I said, a little work to be done. I'm also concerned about this support resistance level here, right around $20. Now, the thing about Joe is that the downtrend line, if we do get a breakout soon, it's enough to get a trade up to that level. If we broke out, let's just say within the next few days, that breakout will happen around 1865, 1870. So that still gives you a little over a point, about a point and a quarter, up to that $20 level. Now that's a key resistance level. If we do break out of the wedge, my expectation will be that that level goes, but one strategy might be to take a partial position on a breakout of the wedge and then wait for that 20 level to clearly get taken out before bringing it to a full position. You also, just above there, you might notice this a yellow downtrend line. That may come into play. However, if things play out the way that it looks they may, what we'd see is a breakout. We'll probably move up. Maybe it might even take this long to get there. So that the $20 horizontal resistance level as well as this yellow downtrend line will probably come in together very close around that time. So my guess is a reaction up around that level. And then once that goes, then coffee looks good all the way up to that, what is that, $23.90, almost $24 area. And then after that, a good 25.50 or so. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed.